Fixed or floating? Which home loan option will make your money go further right now? In Singapore, the refinancing interest rate on an average fixed-rate home loan package today starts from around 2.3%. For a floating or variable rate package, it's around 2.4%. So, is the lower rate always the best deal? For starters, if you are considering a floating rate package, now may be the best time.
One thing that you want to start considering if you want to move into floating interest rate packages is that you want to move into the market now. Now, why is that so? When interest rates come down, so for example, when the benchmark interest rate SORA comes down, it is more often than not that the bank's spread would go up.
I do not really love taking floating rates, but in every cycle, I take floating rates once, and it's always during the highest point where it's really trending down. So that I will ride it all the way down, and I will actually save a huge chunk of money during this next 2 to 3 years.
A floating rate home loan is usually pegged to a reference rate like the Singapore Overnight Rate Average or SORA plus a spread or margin.
Let's say the average rate out there is SORA plus 0.35%, all right? Or SORA plus 0.4%. So note the plus portion, which is plus 0.35. That's because SORA is still high. Once SORA has dropped to normal levels, the normal spreads are plus 0.8. So if you don't secure the plus 0.35 today and you wait until SORA drops, let's say 6 months, 9 months later, you automatically lose about 0.5%.
That means you may be paying a bit more now on a floating rate package compared to a fixed rate one. However, if interest rates do trend lower, you will be paying less.
If you wait a little bit longer, you get clarity, yes, but you're going to get higher spreads. So some decision-making process to be made.
Experts say Singapore home loan rates are likely to fall further in 2025.
If we look towards the last quarter of 2025, maybe fixed interest rates may end up at 2.1, maybe 2.2%, somewhere there. I'm not going to be too optimistic and say it will drop below 2%. I think having rates go back to pre-COVID when you saw 1.65, 1.8% kind of interest rates on average, I don't reckon we would see those rates anymore. Of course, I may be wrong. If a recession hits the market, maybe then, yes.
However, if interest rates move in the opposite direction, one way to hedge your risk is to look for packages that give you flexibility to switch.
When things are still a little bit uncertain, majority of my clients are still going for a fixed interest rate, but they are moving into packages that would give them flexibility. Flexibility to move into a predetermined variable rate on pretty low spreads, or flexibility to move after a year into either a fixed interest rate or a variable interest rate. So that is a good strategy because you can have the upside of just waiting and see whether interest rates come down. But if things go the other way, then you can hedge by using that free conversion and moving yourself into a fixed interest rate so where your risks are limited.
You may also want to check if your bank will allow you to partially prepay your mortgage without additional fees. This lowers your outstanding loan amount, which in turn lowers your future loan repayments. Choosing a fixed-rate package allows you to secure a lower rate now, even if interest rates head higher. That's because the interest due remains unchanged throughout the lock-in period. In a falling rate environment, a fixed-rate package can provide stability.
If you're refinancing a home that you're currently staying in, and some of you just want, some of the clients just want a peace of mind, right? I have a few kids, I don't have time to really monitor the mortgage. There are packages that would help you like that. You have like a 3-year fixed interest rate package, for example, so that gives you some very short-term stability over the next 3 years. But these packages actually allow you, right, to move or take advantage of market movements should interest rates come down by offering you some flexibility of converting like 1 year later, right? So you don't get too stressed up about having to monitor interest rates yourself.
Keep an eye on what happens with interest rates stateside, as that may have an impact on home loan rates in Singapore.
The US Federal Reserve has cut interest rates in 2024. There are signs pointing to further rate cuts this year itself. And usually we have the local banks sort of take reference from the US Federal Reserve rates as well. Not immediate action. So if the Fed cuts, for example, 25 basis points or 50 basis points, we don't see like a knee-jerk reaction that SORA comes down by 50 basis points as well. The banks will still wait and see before deciding what to do.
The interest rate on an HDB housing loan is 2.6%. Experts say now may be an ideal time to switch to a bank loan, which may offer you a cheaper deal. However, here are a few things to keep in mind.
For the most part, if you have a HDB, even with a loan size of $500,000, chances are you'll be able to get something below 2.6% today. I think moving to a refinancing to a bank loan would be a good choice. One thing to consider, however, is that once you move out of a HDB loan, that decision is irreversible. You have to stick with a bank loan.
To make sense to move to the bank, your loan size must be minimally $250,000. Why? Because that's when the bank accepting your loans will cover all costs for you. So there's zero cost. The bigger the loan, the more sense it makes. So $1 million loan, you save 0.2%, you save $2,000 a year. A $600,000 loan or $300,000 loan, you save 0.2%, you only save $600 a year. Every time you do a refinancing, there's hassle involved, right? So is the $600 worth of savings worth your hassle? It's a question that we will ask you as a consultant to the client.
When refinancing, you will also need to take into account costs like valuation and legal fees. There may also be penalty fees. For example, if you break your lock-in period, that will cost you 1.5% of your outstanding loan amount. That's $15,000 for a $1 million loan. So over a 2-year period, you are actually losing money. However, if you're out of your lock-in period, you just need to pay a clawback fee. That's about $2,500. Over a 2-year period, you potentially can save a nice chunk of change.